I'm Andrew Macken and welcome to this week's edition of Video Insight. Over recent weeks, many of Australia's banks have reported their financial results. Having examined these results in detail, one aspect really jumped out that is worth highlighting. Across the four major Australian banks, FY14 marked a year of substantial reduction in impaired assets. In fact, aggregate gross impaired assets across the four major banks were down by over a quarter in FY14 alone. A reduction in gross impaired assets is highly advantageous for a bank. Not only can provisions be reduced, or at least be added at a slower rate, which helps boost earnings growth, but the bank's coverage ratio, that is provisions relative to gross impaired assets, also improves. FY14 was a great year financially for the major banks, and this improvement in reported credit quality was a key reason why this was so. We don't really know the precise reason for such a sharp reduction in impaired assets this year. Management teams referred to a benign credit environment and the like. But what does this really mean? Does this mean that previously distressed borrowers are now more likely to repay their loans? Or perhaps it means that the bank's assessment of underlying collateral values have increased, thereby reducing the bank's exposure to potential losses. Either way, it was interesting that all four major banks reported a significant drop in impaired assets and a material drop in provisions. It was also interesting that these trends did not extend to some of the smaller lenders such as Macquarie or Bendigo and Adelaide Bank. With the outcome of David Murray's financial system inquiry due this month, and with the very real prospect that the major banks will be forced to hold more capital, we can see why there is an imperative for the major banks to keep their stock prices high over the short to medium term. Reporting a sharp improvement in credit quality certainly doesn't hurt in this regard. That's all we have time for today. As always, don't forget to follow us on Facebook and Twitter.